Bank of America CEO Brian Moynihan says he does not expect a recession, despite today's disappointing ISM data. Take a listen to what he said.
Our economists believe there'll be no recession. They believe the economy in the U.S. will go about 1.5% this year. They believe that the Fed will not cut rates because inflation will take longer to get down.
That the Fed will not cut rates?
During 25. They'll cut them in 26. And they've been on that for a long time. And they believe that, and even when the tariffs came in, they said, oh, that caused less economic growth this year than they otherwise scheduled, but still no recession.
Our next guest disagrees, saying 2 rate cuts are still coming this year. Let's bring in 1 Point BFG Wealth Partners Chief Investment Officer Peter Boockvar. Peter, pick your spot in terms of where you would take issue with that view. It's interesting. Both Bank of America and Morgan Stanley saying no cuts this year, and I guess because they figure growth's going to hang in there and the Fed's going to want to wait to see inflation come down. How do you see it?
Well, I agree with Brian that economic growth this year is only going to be 1.5%, if that. That's what we saw in the first half of 2025. The second half of the year, I think, is now in question. And if July's jobs data is any precursor to further weakening, then there's more risk to the downside to 1 to 1.5% than upside. The Fed, to me, they are locked in for the cut in September after they saw the jobs report. And if they don't like looking at the BLS report anymore, all they have to do is look at the ADP report or the employment component of the ISM manufacturing and non-manufacturing reports, and they all still confirm each other. They have every reason, I believe, to cut. But I think we have to. What I want to emphasize, though, is a cut in September, maybe one in December. This is still more rate tweaking. The days of going back to zero are over. So yeah, maybe we'll get a few more cuts, but is that going to be the saving grace to an economy that's still dealing with other challenges like tariffs, for example, but maybe offset by some tax incentives on the capital spending side? But I think net, the Fed is locked in for cuts. It's only going to be a few, but we have to understand why they're doing it. They're doing it because there's been a deterioration in the labor market. And I think you hit it earlier, Mike, when you talked about the stock market sort of weighing the benefits to the markets with those cuts, but on the other hand, trying to figure out, okay, well, they're cutting for economic reasons, and what does that mean for corporate profits in the back half of the year?
I wonder about the ISM services number today, and also just the takeaway from it, because, not to undermine its message, but we went through a couple of years when ISM manufacturing was telling you, based on historical patterns, we should be going into a recession. It didn't happen. Even though the Fed was tightening, it didn't happen. For whatever other reasons, whether it was pandemic stimulus still flowing through. So I'm wondering what your read through on the ISM services number was today. Obviously, a little pressure higher on prices and a little bit lower on new orders and employment.
Well, the way that I break down the U.S. economy, because I think it's important to do so in order to understand the true drivers. I mean, AI spend and anything related to it is a major driver of economic growth. If you're not part of that ecosystem, you are seeing more challenging economic conditions. Government spending, a very powerful driver of growth. Upper income spending is as well, particularly in travel and leisure. But manufacturing's been in a recession for more than 2 years now. The housing market's essentially in a recession. The lower to middle income consumer are basically in their own personal recessions. Global trade is rather muted, and capital spending, ex that AI spend, is actually been flatlining. So it is a very mixed and uneven economy. In this debate, recession, no recession, well, parts of the economy are in a recession, parts of the economy are growing, and in the aggregate, we're basically seeing just 1 to 1.5% type GDP growth, which back in the day was knocking on the door of a recession. 1% growth should not feel good. Maybe some want to call it resilient. Maybe some want to say, well, it's not a recession, but it's pretty punk growth in totality.